Want to generate income from the stocks you already own? You can squeeze more income from your stock portfolio than simply what a buy and hold or set it and forget it strategy can generate. If you want to generate income without increasing downside risk, then consider the covered call strategy. To create a covered call, simply sell one call option for every 100 shares of stock that you own. Selling or writing a call may require you to sell your shares at a set price, called the strike price, up to expiration. Since you already own the stock, you need to decide the sale price of your shares of stock and for what length of time. You can create a covered call ranging from weeks with a weekly option to several years with a leaps option. But the strategy is mostly used with shorter-term options that typically expire in under 60 days. Let's look at an example. Your 100 shares of XYZ stock are currently trading for $62 per share. You sell a 65 strike call with 30 days until expiration for $2, which equals $200 of premium. Regardless of what happens to the price of your stock, the $2 of option premium is yours to keep. When you sell that 30-day call against your stock, the option either expires or is exercised depending on how the stock fares over these 30 days, prior to and at expiration. First, let's look at what happens prior to expiration should the stock price rise above $65. If the stock price rises above the strike price during the 30-day period, then the option may be exercised, which means you will have to sell your shares at the strike price. You still keep the $200 you received for selling the call, and because you sold your shares at $65, you also make $300 on the stock sale. Having your shares called away can happen any time, but it usually happens at expiration. Next, let's look at the various scenarios that can occur at expiration. First, the stock price is below $65 strike at expiration. Since the call that you sold was out of the money, as long as the stock doesn't rise above the strike price, your call will remain out of the money. If, at the end of the 30 days, your call is still out of the money, it'll expire worthless, and you still get to keep the $2. You can also start over again and sell a new call option against the same shares of stock to generate more income. Next, the stock price is at or above $65 at expiration. Let's suppose your stock is trading at $65 after 30 days. In exchange for the income you received, you agreed to sell your stock at the strike price of $65. In this case, your stock rose $3, giving you a $300 profit on your stock position. With the stock exactly at the strike price at expiration, your option expires worthless, but you still collect $200 for the sale of the option, meaning your total gain is $300 via your stock ownership and $200 via your option sale for a $500 overall profit. But what if after 30 days, the stock is trading at $70 per share? In this case, your stock rises $8, giving you an $800 profit on your stock position. You also collect the $200 from your option sale. However, since you sold the 65 strike call, you may be obligated to sell your stock at $65 per share no matter how high the stock goes at expiration. So, despite the $800 gain in the stock, you're obligated to sell the stock for $65, netting just a $300 gain. Combined with the sale of the call at the beginning of the trade, you've made $500. In fact, no matter how high your stock rises, your profit is capped at $500. If after 30 days the stock is exactly where you left it, then your gain is easy to calculate. It's the $200 you collected upon selling your option. But stocks rarely stay put. So let's look at other possible outcomes. Suppose the stock price dropped to $56 per share at expiration, a $6 loss per share on your stock. Since you own 100 shares, your total unrealized loss on the stock position would be $600, but you sold the call option for $2, and since it expired worthless, you keep the $200 for the call sale. Netting out your $600 loss against your $200 gain, your covered call position had a net loss of $400. While this isn't the ideal scenario, you're still better off than not having sold the covered call. If you're a long-term stockholder, you'd naturally be enduring the ups and downs of the stock price anyway, so why not get paid in the process? To learn more about the covered call and other strategies, visit the OIC website at optionseducation.org.